Welcome back to Squawk Box. Futures right now. Take a quick look. You can see down now just under 1,200 points. We've been there for a while. On a percentage, I'm talking the Dow, on a percentage basis, see the S&P is now down 3.35. That puts it in correction territory if it were to end the day like that. Check out energy prices. We got to check out the 10-year too. There are energy prices, as you can see on growth worries. Also, we are almost under 4 at this percent, 4.08%. Joining us now with more on the markets is Bill Nygren, Oakmark Fund portfolio manager. How concerned are you at this point, short-term, intermediate term, and long-term?
Look, I don't think the tariff news is welcome news for investors because of the uncertainty it creates. But at Oakmark, we always try to look out long-term. We try to estimate what a company might be worth 5 to 7 years from now. And then we look for opportunities to buy at a large discount to that. And I think today's market does give us that kind of opportunity.
Already, at this point.
Yeah.
It's not a falling knife.
Well, everybody worries, like, once you're in correction territory, then they start to think they should be cautious. But the data shows that once the market's down 10%, you're no more likely to lose money then than you are if you buy at any other random time.
So you don't care. I can tell you some narratives that'll just curl your toes for what the effects of these tariffs could be. You don't want to hear any of that from me. You just look at where historically how the markets perform, and you think when there's a time like this, this is where you actually, instead of being scared, you buy.
Yeah, basically. I mean, look, I don't want to have your side of the argument to have to try and defend the tariffs. It's a tax increase. Those are inflationary. Those are anti-growth, as any other tax increase would be. And maybe down the road there's something that offsets that. But right now, our job is to try and guess what a business is worth and to make sure that they're financially strong enough that they can survive pretty much anything that happens until we get back to normal.
Bill, let me ask you this, though. In terms of, you're saying a 10% down, not typically a bad time to buy, historically. Right. Historically is the question. What is the parallel that you're thinking about when you say that? That is true for the last 90, or not even 90 years, maybe 80 years, that's been true. I don't know if that's true if you were to look back farther when the issue of tariffs came into play before.
I don't know that answer either. What I'm talking about is in the past 50 years, we've been through 20 times previously when there's been a correction down 10%. And your median return a year or 3 years later is actually a little bit better if you bought once it was down 10% than if you bought it another time. It's something like 75% positive a year out, 85% positive 3 years out.
The thing that I can't figure out is, has the world been rewritten, right? If this is a fundamental shift, then the last 50 years may not be the relevant
might not be long
point. I don't know the answer.
It's so funny for me to be put in this position now, because normally I'm talking about thinking out like 5 years and people say that's such a long time frame, and now 50 years back isn't long enough. Right. You might be right.
I don't know. I'm not saying I may be wrong. I'm not even suggesting that I don't know the answer. I'm just wondering what the parallel is that you think is the right sort of comp for this, only because I don't think we've seen anything like this in the last 50 years.
Yeah, and we hadn't seen anything like a pandemic in the last 50 years. We hadn't seen housing prices go down 20% like we had at the GFC, but those ended up being really good times for investors to add.
You want to, so you don't want to talk about any of the worst case scenarios of what could happen. This almost just sounds like an investment thesis that has worked so well for you up to this point. Could I ask you, if the dollar were to go into free fall, would that change your outlook? If rates, because the dollar is going down, if rates all of a sudden spike higher, they've been going down. I mean, that's one of the best things about all of this. That's the one silver lining to what we're seeing is that 10-year right now.
Look, if you can project macro variables better than the average person can, that can be additive to your investment approach. We found we can't do that. And just to invest long-term in companies when they're cheap has worked very well.
I'm
There are a bunch of companies.
I'm
under
going to
10
believe
times.
you. Okay, so which ones would you be buying today?
Well, I think with the market at about 20 times earnings, we've got an unusual opportunity to buy companies at single-digit PEs that are just kind of left behind as the Mag 7 had sucked most of the oxygen out of the room. You look at a company like Delta Airlines trading just above 40, consensus numbers are over $6 for next year, so you're talking about a PE under 7. Charter Communications, people still think of it as a video company. It's an internet provider, about 8 times expected next year's earnings. A company like Citigroup that's going through a big transformation, 70% of book value, 7 times expected next year's earnings. I think if you buy companies like that, they're already incorporating pretty negative expectations. And it would be unlikely that if you buy today and hold that for a longer period, that you don't come out reasonably well.
For a company like Citigroup, you think the negative expectations are that there's a downturn in the economy, and you know, financial stocks, banks in general, would struggle under a situation like that. You think that's already baked in?
Well, I think it's interesting because the past 2 recessions that we've had, the COVID recession and the GFC, were both such big recessions compared to normal recessions. And those were problematic, obviously, for the banks. But through most of my career, a typical recession was more like what we went through in the beginning of 22, where you had a down quarter of GDP. We talk for the next quarter about might we be in a recession or not. And then by the time you have the second negative quarter, you're already on the way out of it. If that's the kind of recession that might be coming, that doesn't mean the banks lose money. It doesn't mean elevated credit costs.
Right. Can I just go raise back to the, maybe it's the skeptical question, but again, service companies, financial services companies, and specifically, it's a lot easier to not for a business in Europe or in another country that's being tariffed, forgetting about the math of it all, just to say, I'm not using them. I'm using my BNP Paribas in Paris, or I'm using HSBC in Asia, whatever it is, than it is to actually even get out of a manufacturing situation. And so the question is whether this dynamic, whatever we're seeing here, just plays out even as a behavioral science experiment. And that changes the actual math of these institutions.
I suppose it could. You can't ever rule those things out. But the reason Citi has such a great global treasury business is because they've got a better product. And maybe we'll be wrong this time, but at Oakmark, we've always bet that economic forces were stronger and longer lasting than political forces. And it's served us well for the 30 plus years we've been doing this.
You remember where you were when you were on 24 years ago? Do you remember that?
I do.
Mark Haynes was introducing you on September 11th. So you've been a long time friend of, I'll never forget that. Did you come on or did you get canceled?
No, today's actually, I've been doing this for almost 30 years. Today's the first time I've been on set with you.
You were supposed to be on that.
Chicago.
Oh, yeah.
And we were in a discussion. I think I was talking about the cable TV industry back then.
And he said a plane has hit the
sorry, I have to interrupt for a minute. Sat there for about the next 25 minutes with them thinking that they'd be coming back.
Back to you, and you sat there and they never came back. And Jack Welch never came on that day to talk about his book. Yeah. Okay. I don't know why I thought of that, but it really did. Because it's 24 years. You've been coming on a long time, been doing this a long time through that pandemic, through 87, through all.
And somehow you look the same as you did 24 years ago, and I don't.
I think you do too, but I'm glad you said that about me. Feeling good. I'm good. I'm great, and I can sell. Bill, thank you.
Thank you.
Coming up, a lot more on the markets this morning, and our big interview, it is coming up.